I would like to thank each one of you for joining us this morning for this technical session 12, Affordable House Financing Contours of the Growing Market. It is my pleasure to invite on the stage esteemed panel for this session. This session shall be moderated by Mr. Madhusudan Manan, Social Impact Entrepreneur. Our second panelist, Vineet Chhetre, is not here, unfortunately, so we are unable to. He was unable to attend this meeting. However, Jay Shah will be the part of the same. He is the Chief Operating Officer of Swatantrata Microfinancing Corporation. Now, our next panelist is Henrietta Isaac, Independent Consultant Housing, Mona Kachwa, Partner UC Empower, Anjali Tarapur, General Manager, HDFC Limited, Sandeep Menon, Founder and Managing Director, Vastu Housing Finance Corporation. Thank you all. Now I would like to hand over this session to Mr. Madhusudan Manan. Thank you.
Thank you, Anju. So good morning to all of you. It's my privilege and pleasure to be on this dais with two winners of the awards yesterday, Sandeep Menon and Anjali, both are award winners. So I'm sure they have a lot of... HDFC, that's what I said. Sorry. And Jayesh, who's on my left, has been a colleague and also a very keen participant in the affordable housing space for more than 3 decades now. Yeah. And Henrietta, most of you know, was also part of the jury that we were all part of in selecting some of these housing finance companies for their performance. And Mona has also been a friend and an investor and a guide for many years in our own journey as a housing finance company. So I feel personally engaged in this conversation with all 5 of you. Thank you for being here. So I thought to make it a little bit different from a normal panel discussion where we go back and forth, I thought I'll start with maybe Sandeep, since you're sitting at the end. Let's start in order. So the format that we're going to try to follow is that Sandeep is going to introduce himself, his company, and his journey so far, and then maybe a couple of themes that we want to explore as a panel in terms of how to enable or accelerate the pace of change in the affordable housing space. So I'll hand it over to Sandeep now. Please go ahead.
Thank you, Madhu. I think thank you for having me here. And I think just to give you my background, I have been a career banker for the last 6-7 years, actually 8+ years since we started working on this project. But since 2016, 15 end to 16, we started Vastu Housing Finance. I started this company along with my colleague Sujay Patil, who's sitting here. So between the two of us, when we set this up on this journey, I think we're born in difficult macros. 50 crores a book, we had demonetization and then a series of events. But I guess we've been fortunate that we've had a lot of good opportunity in terms of having had access to capital, which this sector has benefited from significantly in the last 10 to 12 years. Along with that, I guess the sheer under-penetration in the segment and the opportunity to actually build large retail lending businesses was really there. So when we set this out, I think it was just me and Sujay. Today we have 3,000 people. We have a loan book of 5,000 plus crores. We are present in 190 markets. We have an NBFC subsidiary. And one of the things that we've done is we've built all our technology, data science and analytics on our own. And that's something that's really worked for us. And along with that, one of the other things that we've done is we've pretty much so far stayed away from the apartment-led business and focused on self-construction and resale properties and the secondary market, and focused on completed properties, so to say. So those are things that we really focused on. But in summary, what I would like to say is that, well, I think we've made a reasonably decent beginning. There is a massive opportunity for people like us and for many, many others to actually build large long-term institutional businesses in affordable housing, and you can make significant genuine impact. And this impact may not be in the top 10 markets in India or the top 20 markets. If you look at the market outstanding in mortgages today, the skew towards the top 10, 12 markets is significant. And that is where the real opportunity lies. So if you go beyond the 40 in the next 300 markets, and if you look at India and break up the top 125 districts which have grown by GDP, and look at, they would have grown at 20+%. There are another 200 districts which are growing significantly well at 10 to 12%. And there is genuine opportunity in each one of them, with land records the way they have got digitized, with the amount of government focus on whether it was the PMAY scheme or the PMI urban scheme, the state government schemes, and a lot of other activity that is happening. I truly believe that it's an immense opportunity for a lot of people to play their part in making sure that the market outstanding on, say, affordable housing goes up from, say, 1.5 lakh crore to maybe it could be as big as the mortgage outstanding, which could be 23, 24,000 lakh crores. So that's the kind of opportunity that we are talking about. And opportunity which is now in a largely credit tested space for, say, 60 percentile of that population, with the bureaus being in India, and with all the stuff that's been done with UPI and digital payments and Aadhaar and everything else that the government is doing, and all the new initiatives that are there. I think the bane of retail mortgages in the smaller ticket segments is high operational risk, highly intrusive lending, and very high on OPEX. And then you go to small towns and small markets, create small portfolios. You have a risk event, you have a market event, or you have people challenges, and then you're not able to execute. I think today the time has come for us to find delivery models and partnerships in different models to execute this and deliver this product in a far simpler and a more inclusive way. One of the things that's actually worked for us is that when we insisted that we need a woman co-borrower on each one of our loans. So earlier, by insistence, we got, and when we moved to the northern states, there was significant amount of resistance. But as I see in the last couple of years, actually women coming in as borrowers, and the government schemes have again helped there, has actually significantly increased. So I wouldn't say it'll be like microfinance, but women ownership in a lot of states and a lot of segments is increasing significantly. And that gives you a lot of control and a lot more predictability of servicing the loans. And also, we need to look at the fact that when you're betting on a self-employed Indian, 80% of our book is self-employed. These are customers, if they're basically putting up half the money, because our LTVs today and for most others in our areas will be 45-50%. You're betting on a self-employed Indian who's been in the same business, same city for 8 to 10 years or more. First generation, first house, 90% customers living in their houses. So the downside risk is very low. It's about scale, it's about execution, availability of liabilities, and to be consistent through the cycle, and understand that this is a business that will take 10, 15 years to build. It's not something that you can do in 3 years or 4 years or 5 years. That's what I would say.
Sorry. Delivery models changing, because I remember in my times in the affordable housing space, we used to go meet customers, decide, and there was only one standard way of delivery model. But we were already talking in those days about things like co-lending, and also working with directly with micro finance companies, or with banks directly as co-lenders. And is that taken off? Is it working? Is it not working? Or if it's not working, what can make it work?
So, Madhu, I'll answer this question in two parts. By delivery models changing, the way I would say this is that you have to understand that the delivery models for a lot of the market in the smaller towns is a people first approach. So, it's not about process, it's not about uh, institutionalizing scale. For every problem, everything you put people. So, you end up having 5,000 people, 6,000 people, 8,000 people. Looks good saying that it's a great franchise, we own all of it, but the operational risks and the market risk and the intrusiveness of the nature of the business, where you have customer data available and information available for all of this, we still go and meet our customers physically, That's the way we still work. But I fear how long customer demands are changing. It's like a Nokia phone going out of fashion. So you'll never know how quickly some of these things can actually change. So do you really want to continue to be as intrusive as you are? Do you want to go and take a photograph of the customer in his residence, in his business premise, and take all those informal references and a variety of other things that have got this industry to this stage? So if I were to come in and build Vastu again, I think today, because of the data that's available, all the government data, all the alternate data, and if there is an interface that can be built by between microfinance companies, affordable housing finance companies, and the MSME lenders, and I think a lot of stuff that government's already doing on some of these areas, and you can actually create the right dedupes. You can actually lend this pretty much on the phone for at least 50-60% of this population. And people who do this first will have significant scalable competitive advantage. Because otherwise, in our current landscape, getting these businesses beyond 10, 12,000 crores, 20,000 crores without reinventing the model will be significantly different, challenging. That's what I would say. And in terms of co-lending, to answer the other part of your question, co-lending is taking off, but co-lending is again taking off in the prime segments. Because what's happening is the banks are still not interested in the small 10, 12 lakh ticket size. While they will take it for PSL, they might rather buy your portfolio. And with the new norms on co-lending, it's pretty much like a portfolio buyout in the new model. So that will definitely take off. But whether the banks take interest in actually partnering and say, when I originate a customer, I put 20%, they put 80%. I think many banks still have a long way to go. And there are issues like multiple amort schedules, the taxation of it, the excess income spread pass through. A lot of these things still need clarity. So I think from our perspective, we have one co-lending partnership with ICICI Bank, which we have quietly tested. We have a full digital pipe into it. And I do believe that there is genuine opportunity to expand because with the liability market still being very, very shallow, and uh, I guess if there are another large number of companies to come in, the viability, the taxation, the scalability of co-lending is going to be very important because you will get to a stage where, like the developed markets, people, the mid-sized NBFCs or the smaller NBFCs or HFCs will typically be the best-in-class originators, risk managers, and portfolio managers for these companies. And the banks and the larger financial institutions will need to warehouse. So if I see Vastu at say 50,000 crores, I might have a reasonably sized own book, but I will also have a managed AUM, which is the right way to go to balance your risk. Because you won't see companies going down on credit risk in this business because effective credit cost could be 35 to 50, 60 basis points. It's the liability challenge that actually makes these entities go down or not scale and then lose investors' money. So the opportunity for the right partnerships in this ecosystem is significant. And I guess we're still maybe 3, 4 years away for things to settle down because the banks still have enough business and there is no inherent need. They're still getting enough direct business. And there is also an ecosystem in the urban markets of the large DSAs, the corporate DSAs. You'll see people who originate large volumes of loans in the big markets. So that's easier for the banks to do and own the customer directly. So I guess things are settling down. Things are much better on co-lending and partnerships than they were. And partnering with microfinance companies, I think, is a genuine opportunity because now, as per the new regulations, microfinance NBFCs are allowed to do 25% of other products. And that's a genuine opportunity. So you could partner. I could never do the Eastern markets potentially on our own. But with the right partner, it's a great opportunity to do. Similarly, there are many companies on the microfinance space where they have successfully delivered other products. I think HDFC, if I'm not wrong, Anjali can add, did a pilot many years back with SKS Microfinance. But I guess maybe it was earlier than time. But today, I think there are genuine opportunities to do many of this.
Yeah, I'm sure Jayesh can add to this conversation because I know some time ago you did some partnerships with microfinance in terms of not exactly co-lending, but co-sourcing, let's say. Yeah. So would you like to add to what Sandeep was saying?
Sure. So we'd tried working with a microfinance company. We still do in West Bengal, and these were deep rural houses and customers that we tried to doing. Now, the purpose of that experiment was twofold. One was try and see how this entire thing unfolds in the rural market, and the second thing was how would a partnership with a microfinance company work. I think we had a lot of learnings, though the numbers weren't significant to really talk about, but I think the learnings were significant. The number one learning was that these are customers who've been credit tested. They have already gone through 2 or 3 cycles of a microfinance loan. So they have that discipline of repayment. Second, sourcing ourselves in those markets would have been very difficult and very, very expensive. And these are customers who have a relationship with that microfinance company, which also I think plays a very significant role in the entire credit assessment. Um, the problem is that the microfinance companies have a different approach, and for them, this is an additional one plus thing. So unless they see this as a big opportunity for their, in their revenue model, and they see significant this thing coming from it, they're not very keen on looking at it very aggressively. And the microfinance business itself has been growing at a rapid pace. So for them to focus on this actually becomes difficult. But if we can have some similar partnerships going, I think it's a great opportunity.
Yeah, thank you. Henrietta, would you like to add to this? Because you have also wealth of experience working with MFIs.
Check. Yeah, thank you, Madhu. Okay, so I'm an independent consultant at the moment, and my experience really comes from working with Habitat for Humanity. Habitat won a USAID grant in 2009 to promote housing microfinance in the country, and with their experience from across the world, we were able to bring in a lot of best practice into the country. And in I think 2011, we were also contracted by IFC to develop a toolkit for housing microfinance and micro mortgage to help institutions get to be able to develop products. And Ujivan was there. Swatantra at the time as a microfinance company, they were the first institution we worked with offering technical assistance. I really got a ringside view of how sort of affordable housing took off from there. So the kind of ticket sizes we're talking about in housing microfinance is really low, 50,000 to a lakh and 50,000 for small home improvements. And these are clients with a limited repayment capacity, with some experience in borrowing from the microfinance institution. And like you rightly mentioned, the relationship is a big part of what makes that repayment happen. And what we saw as challenges that the microfinance institutions were facing was one in terms of funding, because these loans, because they are not collateralized, they cannot be refinanced. NHB does not refinance them. Um, and this mindset change has to happen among the MFI staff. They are so used to this group guarantee, lending in groups. So there's no proper cash flow analysis that takes place, while these housing home improvement loans are really individual loans. So there has to be a different team that might need to be brought in, and that paradigm shift has to take place in the heads of the staff, really. And that is where the technical assistance was helping. And also some level of awareness among the clients to help them utilize a loan properly. For instance, Habitat does what is called housing support services, where they come up with the estimation, a plan, so the client is able to utilize the loan well, in the sense that they do not overshoot what they're borrowing. Sometimes they end up borrowing in multiple sources. So that is one thing, but a lot of these can be solved if there is co-lending that can take place. And I was at a session yesterday where they're talking about how trust is very important in a co-lending model. While banks seem comfortable doing BC, models, co-lending is slightly more sort of a closer engagement, and that might need more trust that has to come in. But it'll be wonderful to see people reach deeper down into the market, and it's lovely to see HFCs really making that effort. Thank you.
Thank you, Henrietta. Anjali, would you like to add something? Because I know HDFC has worked very closely with a lot of HFCs. And how come HDFC never viewed those HFCs as, I know their scales are different, but didn't view it as competition, but as a enabler of financing for affordable homes?
Thanks, Madhu. And it's a great pleasure to be here at the Inclusive Finance Summit, especially to represent HDFC, because very often we're viewed as this huge, looming financial conglomerate. But the truth is, affordable housing is something that is very much part of our journey. And I'm just going to take a few minutes just to trace out what but HDFC, everybody knows that we are the pioneers of housing finance. But when we started out in 1977, there was a lot of skepticism, and it was started out really as a startup. The only difference is today, startups you see are younger people. It was started by a person, Mr. H.T. Parekh, but it was as a post retirement venture. It was in 1977, this venture was looked at with a lot of skepticism. People said, nobody has ever lent to individuals for their housing. Will they pay you back? Then they said, housing finance requires long term money. There's no, at that time in India, there was absolutely no access to long term funding. And the third thing was there were no foreclosure laws. So they said, how are you going to ever recover? We spent almost about 25 years of our journey without any foreclosure laws. But be that as it may, we recognized the need for housing was dire. It continues to remain dire. We recognized that at that point in time, we had no model to emulate. So we adopted a learning by doing model. But over time, we realized that we can't do it ourselves. And that's when, sometime towards the 1980s, we actually promoted competition. So we set up 3 housing finance companies, which was GIC, Canfin Homes, and SBI Homes, which was a subsidiary of SBI in those days, and the first rural housing finance company. We've even helped set up the regulator. The whole point is you can't work in isolation in this field of housing, given the fact that the housing there's such an extreme shortage of housing. But let's cut to 45 years later. Where are we? We have about a 7 lakh crore balance sheet size, about 10 million cumulative housing units financed, and you still see that we've barely scratched the surface. I mean, when you look at a mortgage to GDP ratio in India at just about 11%, you look at comparable countries that all have it in the range of 20%, we know there's so much work left ahead to be done. I'm just going to spend just 2 more minutes just talking about the importance today. Everybody's talking about ESG, environmental, social, and governance. And one of the things that we all need to recognize is that in the affordable housing finance space, there's such a close natural fit with the whole philosophy of ESG. We all know that housing finance fulfills a huge social obligation. The factors that one needs to look at is, are you able to provide housing finance solutions across all income segments? When Sandeep mentioned about, having women as home borrowers, why is it important? It's important because we need to recognize women's property rights, and that's, as owners of those properties, we are recognizing those rights. We need to be looking at just not urban housing, but rural housing finance demands are also very large in the country. The other aspect when you look at ESG is, are you aligning with the government's vision as well? And a lot of us over here have been able to work with the government on their flagship housing program, which was the PMAY, which is the CLSS. The last bit is on the E side, which is a new and emerging area. Climate action is going to become increasingly important, irrespective of what kind of level of lending we are doing. In India right now, less than 5% of residential homes are categorized as green. We are off a very, very small base, but going forward, this is the way forward. We will have to incorporate a lot more of sustainability into construction and into financing. And one may think that, your role of climate in a lending business doesn't happen, but the world is moving forward to say that every lender will now also need to measure their financed emissions, which means for every loan you give, what is the kind of carbon footprint that you're entering. So it's a huge space available, but suffice to say that I think we are all on a good platform. There's enough scope for more and more lenders to come in, as long as we have rational lenders and as long as lenders are willing to share, as Sandeep had also mentioned, learn from each other. When HDFC partnered and gave funding lines to some of the smaller affordable housing finance companies, it wasn't because we had the liquidity available. It was because we realized that there are new ways of assessing incomes, there are new ways of looking at affordable housing finance, and it was a learning journey for us as well. So that journey will continue even in our new avatar as we move towards a much larger bank. But the journey through affordable housing in India is very exciting at this moment. But we have to take the challenges as they come along, all knowing that ultimately, for a country like India, there can be nothing better than working towards building a property owning democracy. And I think all of us in this room have and share that common objective. Thank you.
Thank you, Anjali. I want to move on to you, Mona, because you come with a array of skills and experiences in the sense that you run a mortgage department for a large multinational bank. You have been an impact investor in some of these affordable housing finance companies, and you also run one of them, if I remember right, right, for a brief period of time. So in your experience, I mean, are you seeing change first of all, and are you seeing change in the right direction? Are there any thoughts that you have on how we can accelerate this change to make it more productive and more active?
Thanks, Madhu, and it's a pleasure to be here. Really inspiring to hear all my fellow panelists talk about their work and perspective on this. Madhu, I'll address 2 points, if I may. One is the opportunity itself and the change that people like us would like to see happen. The opportunity, as I think Sandeep also mentioned, is huge. I think some of us who have stayed in this space, very close to the space over the last 15 years or so, that affordable housing has come into focus, we feel that a lot has happened, which it has. And, there are a lot of companies already, but if we look at look at any measure of how much work has happened, while it is motivating and very positive, we are only just scratching the surface. And dipping into my experience of how scaling up of inclusive financial services across other adjacent areas have happened, I would tend to think we need many more institutions than we do today that are specialized and focused on affordable housing. Although every company that there is today has an equal opportunity also to scale up to 10, 20 times the size they are today. So the journey from, in my view, and based on what I've read, about 2 lakh crore of AUM of affordable housing finance as of a recent date, will entail, and to get to a decent size, I think we are just around 10% or 12% of the total AUM of all housing finance at that level. So to get to 10% of whatever the increased denominator is, to at least 50% of affordable housing, will take both in current institutions, big and small, and many more new institutions to be set up. So that's as far as the opportunity is concerned. But as far as the future and the change, etc. Again, I'll just point out one slightly troubling aspect, because I think we've talked a lot about the positives of which I agree on everything. Every time we have a little bit of a headwind affecting the operations of financial institutions, affordable housing finance in this case, the market segment that tends to get defocused or tends to get less capital flows to is the weakest one, or the perceived weakest one. So even the same thing happened in the pandemic, the same thing happened, I would say, during the liquidity crunch of 2018, 2019, where there were ALM issues, led liquidity issues. So the lowest ticket size gets lesser flow, and even though post pandemic numbers, when you see on credit performance, uh, across income segments, across loan segments, loan amount segments, housing finance has performed the best in terms of overdues, NPAs, recoveries, etc., all credit parameters. But when you look through the data within housing finance, the low ticket customers have got less loans than they did pre-pandemic, and it will take us some time to get back to the normal levels. Probably already has happened. So we need to keep this in mind when we are looking at policies, when we're looking at from a government perspective, and so the continuance of policies and incentives to the industry to continue to focus on the most challenged part of the income pyramid in our customer set is very, very important. Market responds for a reason in a certain way. And so the task with the government, with the regulators, is to come and sort of bolster the problem, bolster the risks, and take some of the risk away from the market operators. As far as the change, wearing my investor hat, when I compare with the conversations we have with startups today in housing finance, companies versus the previous generation of companies who have done so fantastically well, I'm very motivated and very happy to see the differences that are coming in today and the change that we are seeing today, which is about, so if we look at very clinically the two sides of the balance sheet, on the supply side, I think as Sandeep also mentioned, the whole long-term funding, etc. I think that part needs to be deepened and bolstered some more. But on the delivery side, on the credit fulfillment side, it's the removal of friction, which is what a lot of the new age housing finance company entrepreneurs are very, very focused on. And as I'm sure the existing companies are as well. So it's very normal for an Indian going out to get a housing loan, especially if you are doing it for the first time, for the first house, typically from an informal income background or semi-formal income background, to wait for 25 days for anything to really happen. So removing the friction there is super important for us to really power through the next phase of growth, because there is, I think, all data now tells us that, and to Anjali's point, when HDFC started, I think just borrowing itself was a novelty, and borrowing for such an asset class was an even bigger novelty among the Indian population. 15 years back, when MHFC and other pioneers in the housing finance space started, for the low-income customer segment, borrowing for 15 years was the novelty, right? And against a asset like housing, etc. So there were many barriers that have been broken over time. Today, none of that is a novelty. What we need to understand, based on the data that we've got from the work that everyone has done, the 2 lakh crore of AUM is showing us, is that the customer pays. Now, whether you have a completely to the T kind of a property title, approved plans, and blah, 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 that the regulation requires, or not. So we have to understand, we have to take the learnings on board and be creative about how we get from 25 days turnaround to something reasonable, 4-5 days turnaround in the digitized world. We have to get to, okay, it's easy to work in a Jaipur, but is it equally easy to work in Jhunjhunu? That mindset. So yeah, I think, so as an investor in the space, that's the progression I would like to make in my journey, which is to look for this change, look for this dramatic change that the digital work environment affords us today, which it didn't 15 years ago.
Yeah, I just want to add to what you were saying, Mona. I think, in my own experience, again, I generally always felt that in a housing finance company, the risks are on the liability side more than on the asset side. And on the liability side, I want to understand from people who are actually in the field whether anything has changed on that side in terms of more liquidity being available, more long-term resources being made available, whether from the NHB or from commercial banks or from government sources, whatever. I know some things have happened, but is it enough or is it too little, too late?
Thanks, Madhu. Let me step back and give a brief introduction on MHFC. Swatantra's journey started in 2009, and we've been completely focused on affordable, but we define affordable a little differently. I would say EWS and LIG is a better word than an affordable housing finance company. We are purely an EWS LIG housing finance company, and for many years initially. On the liability side, the refinance from NHB used to be a significant portion of our total money that was raised. That is changing now. We now have a lot of banks, private sector and public sector banks, who are now willing to look at this asset class, look at these customers and lend to us, though NHB still remains a significant lender. And there's distinct advantages of NHB because they also have very specialized funds like the Affordable Housing Fund and AHF and all that, which actually really makes the loan affordable to absolutely the bottom of the pyramid customers where the incomes are less than 3 lakhs per 3 lakhs per annum. But yes, to answer your question, there has been a significant change. I agree with a lot of things that Mona said, and it was really music to my ears when she said that the focus, we've scratched in terms of the market size and all that. We just scratched the surface, and the biggest opportunity, which why there's not been much of penetration, is that this segment of EWS and LIG actually falls in a no man's land. It's beyond the reach of a microfinance company because typically a housing loan would require at least about 2.5 to 3 lakhs to construct a house. And that's beyond the reach of a microfinance companies at the tenors and the rate of interest that they give to give these kind of loans. It also falls short of typical housing finance companies because to service and source loans of 2 and 2.5 lakhs becomes very expensive. And especially means, since most of the housing finance companies are very growth oriented and they have their sales force which are incentivized on the disbursements, it becomes very difficult for them, or there's very little incentive for them to go and source a 2 lakh rupee loan, where with the same efforts, they can probably go and source a 20 lakh rupee loan and therefore earn a lot more incentive on that 20 lakh rupee loan. So companies like us who are focused on this EWS LIG segment will have to develop a different kind of a model. Will have to see what really excites not only of course the business model, but also our entire team in terms of how do they really motivated to go and serve this customer. As far as the asset quality and the repayment is concerned, I think probably they're one of the best segments. I mean, we've done loans, and when we look at our analytics and see that the loans of less than 5 lakhs, which is typically the EWS LIG customers, have been performing the best, and that's where the maximum scope is. That's where the biggest market is. Of course, there are enough scopes in 10 lakhs and 20 lakhs and 25 lakhs loans also. But there are a lot of players and there are a lot of banks who are already servicing that client. It is this particular segment, which is less than 10 lakhs or sub 10 lakhs, which has the maximum demands and very few really, institutions looking at that segment aggressively. Banks and lenders also, unfortunately, look at the entire housing finance stack as in the same lens as in terms of the regulation, in terms of their refinance risks that they look at, which also needs to change a little. Like Mona mentioned, that we need to look at this segment a little differently. They have a different characteristics. They have a different risk profile. In our experience at Swatantra, one of the biggest challenges in housing finance today is frauds and, imperfect, basically frauds at different levels. We haven't seen a single case of a fraud. These are customers who are first to credit. They're genuine customers who, are very aspirational, need that house. So that risk part is very different in these customers. They probably might have cash flow variations, but they're not consistent. I mean, they probably might miss two or three installments, but they bounce back. We've seen that happen post the pandemic as well. Um, we restructured loans today. More than 70-80% of our restructured loans are, non-delinquent. They come back and, started paying us regularly, which itself shows the resilience that is there. So how do we address this? How do we reach out to these segments? I think that's the biggest challenge. How do we reach out to these customers? They don't even know there's an opportunity for them to actually build a house. And for institutions, the reach is difficult. And that's how I think what Sandeep mentioned, collaboration, I think, is the way forward. I think we need to collaborate. Housing finance companies need to collaborate with different microfinance companies, NGOs, to see how we can actually reach out to these customers and make our sourcing model easier, because they already companies or organizations working with them. If they can actually source, bringing down the sourcing cost for housing finance companies, because the OPEX is really the challenge, reaching out and servicing these small ticket size loans. So maybe a combination of all these factors is, I think, probably the way forward.
Thanks, Jayesh. Again, coming back to you, Anjali, I know that HDFC has been one of the pioneers, not just in lending for housing, but also in terms of how they manage the left side of the balance sheet or the liability side of the balance sheet. A very diversified kind of borrowing base, starting from retail to very institutional to foreign currency. I think everything that moves is on your balance sheet on the left side. So, I want to understand how you manage those risks, and do you see that helping in any way for the affordable housing space? I know when you have such a large balance sheet, it's much easier to do, but some of those skills and some of those benefits that you get from having that wide portfolio would translate into great benefits for the affordable housing sector also. How do we make that happen?
Sure. Madhu, the way I would put it is that irrespective of what size your balance sheet is, the real challenge is not, as you also rightly pointed out, it's not on the asset side. The asset side, there's so much demand. The real challenge of scale comes on the liability side. Now, what sometimes I think the regulators don't always get is that the NBFC lending is different compared to the bank lending. But what happens is if you have a couple of bad apples in the cart, the regulators have no choice but to come and tighten regulation. And I think that has definitely played out in the NBFC market. The regulators has come in quite strongly. You are needing to maintain a larger amount of liquidity on your balance sheet. And we are not like banks. We don't have the access to the low cost funding from the current and savings accounts that banks have. That puts us on an uneven platform. But the real solution for affordable housing finance companies over a longer time is to have created that deep secondary trading market. So, what we have today are still bilateral transactions happening. A bank runs short of priority sector loans and does a loan assignment or takes on the loans. The NBFCs have strength of loan origination. That should really be the focus. And if we have a really deeper an active securitization market that is constantly trading, then on the NBFCs needing to constantly raise resources, constantly raise capital, that comes down a lot more. But for that, we've been talking 20 years about deepening the securitization market. You would know better. We've been talking about 40 years of deepening the debt market. Some of it is a little slow on the uptake. Thanks.
It doesn't happen as often and as deeply and as frequently as it should. But Sandeep, you've done some securitization, right? Or bond issues against your portfolio.
So, Madhu, so the way I would say this is that, see, there is enough opportunity to broaden the debt market. But acceptance of a new entrant is very, very difficult. And as I think Anjali rightly said, if there are a couple of bad examples, which will always be there in a ecosystem like India, the challenges that you understand that this lending is different is very hard for people to get. So while on the one side the regulators are doing what they're doing absolutely rightly so, and it's only the survival of the fittest on that end. But on the other side, from the lending community, the differentiation between, so PSL is a very broad term, but to say that, as I think Jayesh rightly said, you can have an affordable house in Delhi and Bombay, which could be 70 lakhs or 1 crore. But the real EWS or the lower, the real people who, where this 2 lakh crore is going to go to 20 lakh crore, is absolutely the bottom or a couple of levels above the bottom of the pyramid. And for that, you need sustainable long term financing. Because for people who do 8 lakh ticket sizes, 10 lakh ticket sizes, even if you get borrowing which is 6 to 7 years, if I were to say match it with the actuarial life, that's already happening. But the smaller ticket customers will stay longer on your balance sheet. You need longer term financing. And this is not a business where you say, because this customer is small ticket, he's subprime. Small ticket and subprime are two very distinct things. If, for example, you do not have a credit history, doesn't make that first time borrower a subprime borrower. A informal segment income customer could in India be far more predictable than a service industry customer who can lose his job tomorrow. You look at what's happening to all the startup employees in so many startups. I read about a company laying off 70% of its people, and you've seen so many of them. But somebody who's running a small, say, welding shop in a small place in Ongole in Andhra Pradesh, or someone who's doing something in, say, Brahmpur in Orissa. These are people who've been there doing it for first and second generations. So, as I think Jayesh said, maybe they might delay once in a while, but nothing much is going to happen to that segment. So, for the banks to actually give you long term financing at sensible terms for you to pass it on will actually genuinely deepen the entire ecosystem. And these segments need to be lent to differently, also priced differently, because these are not the emerging affluent also. These are people for whom that house is very important, but their incomes are not going to double or triple. So you get to a stage in the economy where after a certain stage, that journey between emerging affluent and affluent becomes easier. And their appetite for borrowing is also very high. So if you look at velocity of borrowing and recency of borrowing as two benchmarks from the Bureau, you'll actually find a set of customers who have 20 trade lines, 25 trade lines, 30 trade lines. And I'm not talking about microfinance customers or loan against gold customers. These are customers who live on retail borrowings. And they are all in the large urban agglomerations and the emerging next 20, 30 cities. But the customers that say Swatantra has or many others have are not in any debt trap. They are customers who are safe, stable. And if you dissect most of this 2 lakh crore book into segments below 5 to 7 lakh and 7 to 20 lakh, and then you say the above 20 lakh, the behavior post COVID will be drastically different. Because post COVID, the bigger ticket customers who have had access to more velocity of borrowing have done well, and people who are staying in their houses would have done well. But the people who have suffered are the people who have paid you back. It's actually, except for migrants who would have lost their jobs in a couple of markets and gone back to their villages, a large part of the smaller ticket customers have come back and paid you all. So if you ask me about our restructured loans, we would have build our restructured loans now for 9 to 10 months. And I think we have similar numbers in terms of 80+% of our customers pretty much back on track. And we did 3 month and 6 month restructuring for around 450, 500 accounts. And the integrity of the smaller customers is far, far higher. So the ecosystem has actually made them suffer post-COVID. So post-COVID, the number of the smaller ticket borrowers is honestly far lower. So to address this, so I'll tell you, and the other point, I think Jayesh again made that point, I'm repeating it, is that you can't have the same salespeople or the same distribution sourcing a 10 lakh rupee loan or a 20 lakh rupee loan and a 5 lakh rupee loan. So I was always believing that the same people could do everything, because I, for a long time, believed that I could do what I did in a bank outside, and maybe that's not the right thing to do. So, over the last 3 years, we've looked at the space very carefully. Last 1 year, we've actually put together 300 people to actually build a micro housing business. And when you look at ROA or ROE or break evens or branch profitability, many other things, this business will take a lot more time, but it's absolutely the right thing to do. And if you have cost of fund access, and if you are able to actually drop 150 basis points or 200 basis points, you will get a lot of these customers who today have no choice but to wait for 20-25 days and borrow as MSME or anything else, or from the informal market. So that opportunity is very significant. And if long term debt is available, it really helps. So I'll tell you, if, for example, Anjali is here, and when we started, we had HDFC Limited as our day one lender. We had HDFC Limited, HDFC Bank, Sundaram Finance, and DCB Bank giving us money day one. We were fortunate, we got these four great institutions to give us money, so everybody else gave us money. But for a lot of people who really want to do this, they don't get this support. And then those businesses don't take off. And then there is so much grief and so much anxiety. And for every failed business or about to fail business, there is so much anxiety from the capital providers, rightly so, that they are very, very skeptical whether the opportunity is come and gone, whether more capital, whether it's going to sustain, whether banks are going to come and take over or not. So I think patient capital businesses with support is very, very important. So I think we have been fortunate that we've gone back to people like HDFC and many others, and they have guided us on what not to do and shared learnings. Jayesh, again, I think whenever I meet him, we pick up something. So it's important for that ecosystem to come together, because if you get the next 10 companies to really do well and have a long term patient view that this will take 10-15 years and the opportunity could be 30-40 years, and if the market outstanding grows from 20 lakh crores or 22 lakh crores to wherever it goes to, affordable housing has a genuine opportunity to be 30-40% or 50% of the market outstanding. That's the opportunity.
Yeah, I mean, I can see that in the sense that, we are all agreeing that, the asset quality in this segment is pretty good. I've seen tremendous innovation happening in the terms of delivery mechanisms, in terms of customer acquisition, customer retention, customer servicing. However, I don't see the same pace of innovation happening on the liability side, which is my question. That, why is it that, we can't figure out a better way of making cheaper resources available on the liability side? Where I know NHB is doing a fantastic job in terms of, but it's one small portion, and most smaller affordable companies run the risk of being too dependent on a single source. So it's important to diversify the sources of financing. It's also important to keep the prices low, access to maybe even FCB markets, access to domestic bond markets. I mean, these are things that we've been talking about for last 15 years, 20 years, but we just don't seem to be able to make that happen, the same pace of innovation that you see on the asset side,
So, Madhu, the
which
key,
troubles me.
one point that I would make is that essentially it is a question of there is no initiative for the lender to do this. There's absolutely, so whether if it is ESG mandated or something else, then there is an initiative. So if there is an opportunity for lenders to go and give money to potentially safer segments, then they don't want to actually take that incremental risk. And if they want to take that risk, they want to price it and structure it in such a way that it is unviable to execute and benefit the bottom borrower. And the amounts are small. And when the amounts are small, rightly so in the early days, everybody follows the same thing. So unless you are mentally ready that, yeah, and have the capability to take in deep slugs of capital early, and don't worry about, say, how much money we will make or what valuation we'll get, because institutional makeups are important. If you are willing to be institutional in your makeup and see through the first couple of years and have patient capital providers, then I think the debt play will sort itself out. And the multilaterals and the others are now sincerely taking an active interest, but their time to market is very slow. The challenge is you have to engage with them for a year and a half for you to get something meaningful. And unless you are at a certain credit rating, even they want to price for all the risks, and the margins and the terms are tough. So I guess it is a bit important that some large institutional lenders and the banks, and not just the public sector, the private sector, plays its part, because they all have their PSL targets, and the government can also do something to make sure that it's not just a broad brush mandate but a specific segment led mandate.
Yeah, Anjali, do you want to add to that? Because you've done that journey already. Please go ahead. Yeah.
Yeah, I totally agree with what Sandeep's saying. I think from my vantage point, I see a lot of the focus in the recent few years going a lot more towards the MSME lending segment. I'm talking about the sort of government support programs and of also the development financial institutions of the country and overseas. A lot of support seems to be from the liability side, seems to be focused on that, which is good. But perhaps there is a perception that NHB is there and NHB has done the good work and the market is moving in for the rest of it. So a refocus on that question, whether we need another pool of capital which supplements what NHB does and initiates, is possibly the need here.
As far as I know, even NHP themselves do not do more than a certain proportion of your liabilities.
Yeah.
So you have no choice. You have to diversify on your liability side, and you're kind of restricted because there are a few commercial banks who are doing it purely for priority sector needs, and there's not. I'm not aware of a single foreign bank which is lending to any affordable housing finance company, though I cannot understand why, because they also need priority sector. And there is hardly anybody who's actually done a bond issue
Yeah.
based on the quality
if-
of the portfolio, rated quality of portfolio, but it's just not there.
And if you juxtapose this, what we are seeing in our respective, work, with the intent of the government to take the PMAY target from 10 million to 30 million homes by 2024, that's going to require a lot of this capital, extra capital to come in.
Anjali, tell us how you got there.
The way we got there, the reality was in 1991, we actually printed out ads to say we've got so many customers, and this was at the time of the economic crisis, the first time, just before liberalization. We actually printed out ads which says that, thank you for your interest. We've got lots of customers, but we're going to actually close. We almost thought we couldn't incrementally take on any more borrowers because we didn't have fund. And Jayesh, you would be there at that point in time. But fortunately, we recognized that what we did is we went on to the retail deposits. And at that point in time, the regulations allowed you to take retail money. Now, every time we've had a financial crisis, which comes to us almost every decade and a half at least, retail money is sticky money. It stays with you. It's a little higher cost funding initially, but it stays. But the problem again is that the public has been so badly shortchanged earlier in the 1980s, 1990s with all those NBFCs mushrooming, taking public deposits, that the regulators have just clamped down totally. So today, not a single NBFC over the past, I think 10, 12, must be more than 15 years now, has been allowed to raise public deposits. But the savior was public deposits, which is coming back to the point of, irrespective of the balance sheet size, we all have common problems. But one thing we have to appreciate, that the PMAY scheme is a success. It was a success. We understand that fiscal resources are limited, but the model that came through, for instance, the credit-linked subsidy scheme, I think that really worked well. And maybe, Henrietta, you might want to also talk about the other scheme of the PMAY also, because it is something that has worked well.
Yes, maybe Jayesh can talk more about it, but what I can say is that Habitat has been looking for financial institutions who will do the gap funding, because the subsidy itself, the BLC piece of it, is not sufficient to build a house. So Habitat has partnered with Swatantra in Odisha particularly, and they've been able to do a good number of loans. And these clients have been able to repay. That brings down the EMI that the clients have to repay, the subsidy coming in. And with the housing support services that Habitat provides in terms of coming up with the estimate, the plan, linkages with the government, and with all of that support, the clients have been able to access the PMAY scheme and build houses using that. And maybe Jayesh can talk more about that.
Yeah, on the PMAY, I mean, there have been three verticals which have been mostly talked about, and the one which has been most talked about is the CLSS, which in the EWS LIG segment has made a huge impact. So there were certain houses which the government constructed under the AHP vertical, but that supply was limited. So because of the CLSS, there were a lot of private sector builders who actually got into construction of houses which were, costing less than 20 lakhs, 15 lakhs, and they were with a, some houses, the normal average cost of a EWA house in a private sector was about 8 lakhs or 9 lakhs. Now, with that kind of costing, the average loans were about 6.5, 7 lakhs, and at a 6.5, 7 lakh rupee loan with a 2,60,000 subsidy coming in, it was very, very affordable for these customers. And a lot of these customers would have probably never been able to afford a house had it not been for the CLSS subsidy. Having said that, the other vertical which Henrietta mentioned is the BLC vertical, where which is where also the PMAY subsidy has been very, very effective. For example, the Orissa pilot that we have been doing with the Habitat for Humanities is where typically house construction cost is about 4.5 lakhs. There's a 2 lakh rupee subsidy from the center and the state. So the remaining 2.5 lakhs, out of the remaining 2.5 lakhs, 50,000 is what the customer contributes. And the average loan ticket size is 2 lakhs. Now, the biggest risk and the challenge for a housing finance company in a self-construction is to get the right estimate and then monitor the construction so that it doesn't deviate from the initial estimate. And that's where Habitat's technical assistant comes in, where they monitor the construction, ensures that the construction is, as per plan. There are no cost escalations, and we do the gap funding of 2 lakhs, and it's worked really well. These are customers who are fishermen, selling shells on the beaches. So really the bottom of the pyramid kind of customers, and the repayments have been good. The house conditions have changed, drastically. These were all people staying in thatched houses, would get blown away every time there's a cyclone, and now they have proper, houses to live in. So definitely, PMAY has made a huge impact, and even the AHP vertical, which is not very often talked about, they have some, how many lakh houses. We keep hearing those huge numbers across all the states, and there are very few EWS houses where allotments have been made, they have been completely funded, and they have actually been occupied. And the only reason why that's not happened is there's not enough finance available for these customers to actually go and make the payments for the allotments of the allotted houses. So both these AHP and the BLC verticals have been extended till 24 for them to get completed and hopefully enable people to do that. But the impact has been definitely significant.
That's good to hear. I thought, we've got a few more minutes, unless any of you have any closing comments to make. Otherwise, we are open to take any questions. If anybody has any questions to any of the panelists, we can try and, to the extent possible, answer them. Otherwise, lunch awaits. Yeah.
Can I just say one thing?
Yeah, please.
I'll be remiss if I did not talk about the kind of impact this can have in the life of a family that does not own a proper home. And I've spoken to these women, particularly women, the security that comes with a house, the dignity it gives them. And women, I've heard them talk about how in their kacha houses, if they saw strangers wandering in the area, they would not be able to sleep the whole night. They'd be awake, wondering, who it might be, and especially if they had girl children. And they talked about how their life, the quality of their life changed entirely with a Paka house, and they say now I can sleep at night. Now I have peace. So that is really why we're all here, I think. And yeah, that's something I wanted to bring to your mind. Thank you.
Thank you, Andy.
Am I audible? Yeah, I have a question for Anjali ma'am. Basically, I wanted to check, post the merger, how are you envisaging your journey forward, and what is in the store for smaller affordable housing companies in terms of partnerships going forward?
Gosh, I feel now I'm back again in an investor conference than anywhere else. The idea is really to benefit on the larger distribution that there is within the bank and the access to lower cost funding. So, the commitment to affordable housing, the commitment to the housing finance space remains absolutely resolute.
Hi, Devdut from Axion. I had a question on informal titles. Just wanted to understand that do you see any movement towards institutions funding properties with less formal or informal titles? Do you see any development on that?
Sandeep, you want to have a go? Okay, sure. Well, what is an informal title and what is a formal title? I think that there's no clarity there. For a person, whatever we call it as an informal title, say a patta, for him, that's the document he has. And that's as valuable for him that as much as probably for me a proper registered sale deed is. So the informal title, as far as the customer is concerned, there's no differentiation really. The challenge is in the refinance. I mean, as far as the credit, as a housing finance company, as a credit, the credit of the customer, whether he's going to repay the loan on time or not, is not going to be dependent on what kind of uh, document he has. It's basically going to be on his cash flows, the need for the house, his own equity in the house, and various other lot of factors. So the question about informal and formal title comes in and becomes important when we actually try to raise money and get a refinance against these kind of loans. And that's what we've been trying to talk to the banks, regulators, and all that we need to define that and look at it a little more realistically. If we were to do EWS LIG housing, there will be, like Mona said, not going to be a perfect title possible every time. And we have to define what is acceptable and what is not acceptable, and how is that going to really, get covered into, increase or decrease the risk of the portfolio or the loans that we are doing. And now we have sufficient history and track records of these loans, and probably it's time to look at it again without the initial biases that we have on informal and formal titles.
Anybody has thoughts on that? Because this is something that we constantly debate, right? Informal, formal. I think, and Rita,
So there have been institutions that have lent using a document from the Gram Panchayat, which states who owns the house, and based on that, and then hypothecating that. There have also been instances where you can apparently create a document, an occupancy document, again with the local government authority, stating the borders, and that this person has occupied it for so many years, and so now it belongs to them, and then hypothecate that. So those things are possible to do. And in case of, I think, Swatantra, they have used an LRC, which is the ownership document that the Odisha government gives. This is not transferable, but it still proves ownership, and that is what they are happy to look at. So these are different methods that affordable housing companies do.
Yeah, just to add to that, a lot depends on the state government and the state government policies. One, at one level, and secondly, how are these policies actually, downloaded to the local bodies? Like the Orissa example, under the Jaga mission, they have probably issued more 6 lakh land rights certificates. Now, these are not title documents, but they're land rights certificates where they can, the plots have been very clearly earmarked. There are their rights to use them, which are not transferable. Transferable, it can go to the next generation, but they can't sell that based on the land right certificate. But these documents are mortgageable, so they can raise money for them, for construction of a house. So these kind of innovative initiatives by state governments and all that, I think, can help.
Even simple things like reducing the cost of registration of property. And I think Jharkhand for a few years had a registration fee of only 2 rupees if it was in the name of the woman. That has changed now, but if you can reduce the cost of registration, then that encourages people to register their document, and then everything becomes more transparent. Sorry, somebody had a question. I think.
My name is Raghavan. I used to work for microfinance company. The regulations in terms of every state governments have regulations in terms of town planning authorities and all those kind of stuff. And there's a lot of difficulty in getting a plan even before I apply. You guy household has some 200 square feet or 300 square feet, and getting a town planning and house plan becomes extremely important, which is very important to apply or get a loan. And how does the housing finance company, especially this segment, navigate this issue, or do you find any issues in that?
I think very valid question, and truthfully, there is no perfect way to navigate it. What a lot of housing finance companies do is to tell the customer that if you need a loan, you please go get this plan done, get it certified. That is the only way we can give you a loan.
Something that I have seen in some cases is that where either if the title is not perfect, in the classical sense of the word, and requirements such as approved plan is not there, what the customer ends up doing is financing the construction or the purchase through other means, and then comes back and takes a loan, like a home equity loan of some kind or a home loan to replace that interim bridge financing. And the interesting thing is that at least where I've had the opportunity to see the performance of these portfolios, there's really almost no difference between a pure home loan done in the right order, or this sort of a refinancing kind of options that the customers take post facto. So that is also a reason for us to rethink this whole approach towards title and approved building plans, especially for small ticket loans.
Continue.
The issue, I'll just take a few seconds because I just wanted to kind of look at these challenges that the segment takes. Now, if you look at last 6 to 7 years, the loan against property between a ticket size of 2 to 5 lakhs is growing at a very breakneck speed. And on in-depth analysis of these clients, we find close to 30% of it goes to housing because of the complicated, plan and all those kind of things. But what they lose out is on the interest rates. That's as good as 22 to 24%. If it is housing one, it becomes eligible for a pretty far more discounts and a cheaper rate of interest. So I'm just trying to see, is there any advocacy where, of a particular plot size, can you exempt it? I'm just trying to just
It's
put forward a thought
very
process.
good point, something that the Association of Housing Finance Companies should take up.
That's one. And there are quite a few local bodies and governments that have taken cognizance of this, that there are a lot of small plot sizes and the kind of delays that happen in the and the process of the town getting the plans and all that approved is becoming difficult. So a lot of states have defined a minimum plot size below which permissions are not required, as long as they follow the bylaws in terms of the setbacks and the other specifications in terms of the heights and everything.
So we're good to go lunch, and so I want to thank you all for a good discussion, and I hope that some of the suggestions and some of the thoughts that were expressed, that like they say, from your lips to God's ears, and hopefully somebody will hear and the urban planners' ears. Yeah. Thank you very much, all of you, for being here. And yeah.
Thank you, all the panelists, for this great session. As a token of appreciation, I request all the panelists to please accept these souvenirs.